Welcome to SBR September-December 2019 paper. So this is section A, question 1. And first, we are going to start with the reading requirements. Because I have taught you that always in any paper in SSCA, always start by reading requirements because that will give you a clear idea of what you are looking in the case study. So let us read requirement A. Draft an explanatory note to the directors of the company addressing the following. So you have to make an explanatory note to whom? To the directors of the company. Explanatory note is not, it does not have a standard format or all. It's just like a note you're explaining. Question A. How the fair value of the factory site should be determined at 1st of July 2004. Now, date is very important, especially when it comes to fair value. You should always highlight the date because the value keeps changing, right? And why the depreciated replacement cost of 17.4 million is unlikely to be reasonable estimate of fair value. First 7 marks. So the main thing is about fair value. How it should be determined. That means how it should be recognized, measured at this date. And why the depreciated replacement cost. So the depreciated replacement cost is this much. Okay, here they have already told you that this is not reasonable, unlikely to be a reasonable estimate of the fair value. You have to tell why. Coming to the second one for 3 marks. Even though it looks 3 marks, what happens is you try to neglect, ignore it, thinking it's just 3 marks. But each mark counts for you to get that 50 mark. Remember, to pass, your pass mark is 50 mark. Even though it's less mark. Sometimes it's not so easy to get even those 3 marks also. Sometimes the more marks you get scared that, oh my god, so much of marks. But it's easy to score when the marks are more because you have lots of workings and all, even if your final answer is wrong. But when it's for 3 marks, 1 mark, 2 mark, it's more difficult to score that mark because you have to be very specific and the answer has to be right. Here it is calculation. Calculation of goodwill arising on the accusation of the company, measuring the NCI at fair value and proportionate share of net assets. Very easy, right? Because we all know that there are 2 ways to measure NIC, non-controlling interest. One is at fair value, one is proportionate share of net assets. Under both methods, you have to calculate goodwill. Calculation of goodwill using 1 and 2. Next, B. Discuss the calculation and allocation. So when you are reading part B, if you see the marks, that's for 11 marks. Highest mark is here. That means it has a lot of workings here. Calculation and allocation. Okay, it's not just calculation, also allocation. Calculation, you have to discuss the calculation. So doing calculation, calculate something and discuss the calculation is not the same thing. Remember that. So here, discuss the calculation and allocation of the company's impairment loss at 30th June 2008. So this is about impairment loss at 30th June 2008 and why the impairment loss of the company would differ depending on how NICs are measured. Why this will differ based on how this will be measured. You have in part A, second one, you measured goodwill by using 2, right? NIC by using 2 methods, fair value and proportionate. So when you measure NIC by 2 methods, even your impairment loss will be different. So why that difference is there? Your answer should include a calculation and explanation. So calculation also, explanation also. Most of you already worry and focus already on calculation and leave your explanation. That's how you lose marks. Of how impairment would impact upon the consolidated financial statements of the company. How it will affect on the consolidated financial statements. The impairment. C. How the consideration for the accusation of Hammond Company should be measured on 1st of July 2007. Again, consideration. On this date, how it should be measured. There are many ways of measuring consideration for accusation. Okay. So your answer should include a calculation of the consideration and discussion of. So there are two things here. Calculation of the consideration is one thing. Other thing is discussion of why only some of the cost of the replacement share-based payment scheme should be included within the consideration. So that means clearly this gives you a hint, even if you're not sure what to include, what not to include. This is a hint that only some of the replacement share-based payment schemes are included in the consideration for accusation. Only some, not all the cost. So this also gives you a hint that if you're trying to include all the cost, you're wrong, only some. Next, how much of an expense for the share-based payment scheme? What is share-based payment scheme? It is IFRS 2. You have to be strong in that to deal with this. It is clearly linked to IFRS 2, share-based payment scheme. If you're strong in that, all the concepts, this is nothing for you. You can deal with it. So knowing which IFRS or IAS is linked to which requirement is also important. That will help you. That shall help you. Like for how much of an expense of the share-based payment scheme should be recognized in consolidated profit and loss? Expense for this one should be recognized in profit or loss. Consolidated profit or loss for this. Your answer should include a brief discussion, also discussion of how the vesting conditions impact upon the calculations. What is this vesting conditions? You will already know if you are thorough in your IFRS 2. We'll go through the answer, then you will know it better. Any workings can either be shown in the main body of the explanatory note or in the appendix to the explanatory note. Workings like your calculations on all, where you have to do some workings for that you can show in the main body also or as an appendix also. So this is for 30 marks. Okay, now we are going to go to the case study. Just see how many minutes I spend to read this whole requirement. Around 7.5 minutes. For you, it should be even less because I am taking time to explain you. I'm stopping in between and explaining you. That's why it's taking more time. But for you, you will just be reading it. Now let us read the case study. First, background. The first paragraph is always about the background. Quickly, you can read it. Not much information is there. So, Luploid is the parent company of a group undergoing rapid expansion through acquisition. Luploid has acquired 2 subsidiaries in recent years. So, the 2 subsidiaries are this and this. The current financial year end is 30th June 2008. Accusation. So, you have been given the accusation of an impairment. An accusation of this one. So, this another thing, how to know which paragraph to go with which requirement is this. The heading of the paragraph will tell you which one you are requiring for which paragraph requirement. There are 3 paragraphs here. Accusation of the first company, impairment of that company, and accusation of the second company. So when you reading the requirement here, they told Luploid, right? It is a parent company. Here they are talking about the first company. So you don't have to think about the Hammond company. Forget about it. Hammond company already comes here in part C. In part C only. Where is it? Here. So only from your part C onwards you have to use. Right? And here they have talked about in part B. Calculation and allocation of impairment loss. So this impairment loss comes where? Part B. That means this one. Impairment of this. So this will go in part B. This is part B. You can even link like this also. From part B. Part C. Right? This is part C. Can you see that order? The way the case study is presented, your requirements also will be in that order only. B, C, both B, first and second is for the last paragraph. And A. Here, it is A. Both part of A. Can you see? A, B and C. So, either you can read the whole case study, but I suggest that's not a good way. Because when you read the whole case study, you might get mixed. You might mix the two things. You might jumble up. So rather read one paragraph which is relevant to that requirement, finish up that requirement, then go to the next paragraph, read it, and then answer. Okay, so I follow that strategy. That's more time saving. That saves you a lot from panic and stress. You don't panic because usually case studies are very lengthy and long. When you read the first paragraph, when you go to the second paragraph, you already forgot what you have read in the first paragraph. That's why, in order for you not to do that, it's better to finish up the requirement as soon as you finish reading the relevant part for that requirement. Let's say I'm only reading now. Let me highlight only this paragraph. From here, Leopold to here, million. I'm only going to read this paragraph, this much, for my part A, first and second. Okay. But this is not always. Sometimes you have to read the case study more. Maybe the other parts also relevant for the first one. But here it is clear cut. So Leopold acquired 80% of the 5 million equity shares. Remember, you have to calculate NIC also. So I am going to highlight how much it acquired, 80%. That means NIC is 20%. NIC is what? 20%. Can I write it somewhere? NIC 20%. Of the 5 million equity shares. Another thing is important. How much? 5 million equity shares. Dollar each. On 1st of July 2004 for the cash of 90 million. For how much of cash? You need to calculate goodwill. So you need the cash also, the consideration also. Cash 90 million. The fair value of NIC at acquisition was 22 million. NIC, the fair value is 22 million. The fair value of the identifiable net assets at acquisition was this one. Fair value of net assets is this much. Excluding the following asset. What is that asset? We'll see now. The company purchased a factory site several years prior to the date of acquisition. Land and property prices in area had increased significantly in the years immediately prior to 1st of July 2004, before the date of acquisition. Nearby house has been acquired and converted into residential use. It is felt that should the company site also be converted into residential use, the factory site would have a market value of 24 million. 1 million of costs were estimated are required to demolish the factory and to obtain planning permission for the conversion. 1 million of cost. That is for demolishing the factory and for the conversion. The company was not intending to convert the site at the acquisition date and had not sought planning permission at that date. So they didn't convert also. They have no intention of converting and they didn't get the permission also at the date of the acquisition. So now this is an area where you have to think whether you have to include this cost or whether you don't have to include this cost with the net asset. This is a thinking area. That's why this information is given. You are expected to get this type of information. Sometimes you have to include, sometimes you don't have to include, but you have to give your reasons. It's not just because it is given you will include it. No, you have to see the facts and the circumstances. So the depreciated and another requirement was this about depreciated replacement assets. So the depreciated replacement cost of the factory at 1st of July has been correctly calculated at 17.4 million. It is correctly. There is no wrong, but it is, if you are coming to the requirement here, they are telling it is unlikely to be a reasonable estimate of fair value Y. That you have to tell. So now can we go to the answer and see? So let us go to the answer. Now here the question asked about fair value measurement, right? What is the requirement? Again, we'll go through the requirement. After reading the case study, again, it's your duty to go through the requirements to see. First requirement, I'm only dealing with first part of A, fair value of the site, how it should be determined at 1st of July 2004, because 1st of July 2004 was the date of acquisition. If you forgot 1st of July, the date, you can even write it, date of date of accusation, right? So how it should be determined and why this is an unreasonable estimate of fair value 17.4. Two things you have to answer for 7 marks. So let's see how the answer has been presented. If you see here, how many paragraphs are there? Before even reading the answer, read the paragraph. 1, 2, 3, 4. Just count the number of dots. 4, 5, 6. 6 are there. And if I can see 1, 2, 3, 4, the first 4 paragraph, first 4 paragraph are for the first part of the requirement. How fair value has to be measured, determined on 1st of July 2000. The next 2 paragraphs, which is this one and this one, is for the second part. I'm sorry, even this one is also for the first one. Only this one. The last paragraph is for the replacement cost. Depreciated replacement cost 17.4 million. Why it is not reasonable fair value? So now we'll see. This answer you can take from here. How a fair value is measured from the standard they are taking. This is even there in your textbook also. So you don't have to panic how I'm going to write this answer. Some of the answers are common. It's like you can even copy paste, you can even memorize it. I don't encourage to memorize. Understand it. Once you keep repeating writing this answer over and over again, how fair value is measured, it will automatically be there in your mind. So first is IFRS 15. Let's see how they are writing. They are starting with the number IFRS 13 fair value measurement. They are naming that standard. For your case, in case you forget the number, you don't know which IFRS it is, if it's wrong, I encourage you, don't put any IFRS. You will not be penalized. As far as you write the standard, the principle in that, the rule of the standard, you will get the marks. But if you forgot the number, please don't put wrong number, because it could mean some other standard. Let's say in case of IFRS 13, you are writing IFRS 16. That would be another standard. So don't do that. Right? If you're confused, what is the number? Don't write it. If you're sure, very sure of the number, it's better you write the number. Like this. IFRS 13 fair value measurement. In case you forgot that IFRS 13, just write fair value measurement permits a range of. So you can start like that. Or in case you remember the number, you don't want to name the whole thing, no need to write fair value measurement. Just write IFRS 13 permits a range of valuation, like that. It is understood. So IFRS 13 fair value measurement permits a range of valuation methods to estimate the fair value, including market-based, income-based, cost-based approach. Can I highlight it? One is market-based, one is income estimate, one is cost-based. There are 3 methods how you can measure a fair value. This is fixed by the standard. So you have to know that. This you have to write in your answer. 1 mark is for this. It is not, so when fair value measurement does not say there is only one way to measure fair value. There are 3 methods. There are ways. One of these is market, income, or cost. However, the characteristics of each asset should be considered when determining the most appropriate methodology. Exactly. It is not only, you cannot say for something use market base if there is no market base information available for that asset. There you have to use some other method, maybe cost or maybe income. So you have to see also the asset, type of asset. Looking at the characteristics of the asset, which is suited, which method will be most suited that asset, that also you have to see. That is the second line. Now coming to the second paragraph. Okay, let me write number of paragraph 1 so that you don't get confused. 1, now 2. Now I am in the second paragraph. Fair value is determined as the price which, now they are giving you the definition of the fair value. You also give the definition of a fair value very briefly. Don't write pages and pages explaining what is fair value. It should not be 4-5 lines. Just 1 line is enough. Fair value is defined as the price which would be received to sell an asset or pay to transfer liability in an orderly transaction between market participants at the measurement date. Fair value is like when you're selling, let's say I'm selling a pen in the market, open market. So the price which I will receive for that pen, that is a fair value. That is known as fair value, right? So fair value is therefore not supposed to be entity specific but rather to be market focused. Yes, it is not entity. For one entity, a pen will be $20. For another entity, it will be $30. Not like that. It is based on market only. Right? So another thing it is, fair value is not entity specific but market focused. It is market focused. And also the definition. Here it is the definition. The first line. Definition of fair value. See how they are proceeding? First they told Ifrs 13 what it allows. Range of measures. Next paragraph they defined fair value. They also told it's not entity specific but market focused. So the estimate consequently should consider what the market would be prepared to pay for the asset. Yes. It is a market that decides. Coming to the third paragraph. Let me write. Number 3. So the market would consider all alternative users for the assessment of the price which they would be willing to pay. Fair value should therefore be measured by the consideration of the highest and the best use of asset. Let me highlight it. Measured by consideration of highest and best use of asset. This is how fair value will be. This you have to write in your answer because the question tells you, requirement tells you how a fair value should be determined. So this has to be there in your answer. That it is measured by consideration of highest and best use of the asset. There is a presumption that the current use would be the highest and the best use. It's a presumption that the current use is only the highest and the best use. Now coming to the fourth paragraph. The highest and the best use. So now you are explaining what is this highest and the best use in the fourth paragraph. See how they are keeping each point in different paragraphs. One specific point only they are talking in one paragraph. So the highest and the best use of the asset would appear to be as residential property. Okay. Here in this case, I'm not saying in all case. This case it is residential property. And not the current industrial use. Not the current industry. You have to clearly say what it is not this, it is this. That you have to tell. It's like my name is Sabi, my name is not this. So you have to say like that. If they ask what is your what do you say? Are you a male or a female? So you say I'm a female, I am not a male. So this question is also like that. Right? So the intentions of the company. You have to link to the company, my dear. Just because till here we are general answers we are giving. But with this company, we never mention about this company. The company's name has to be there in your answer, any answer. So the intention of the company are not relevant as fair value is not entity specific. So here, because here they have told that fair value is also determined by the intention. Fair value is not determined by the intention of the company. Because clearly fair value here they have told. I have highlighted also in the second paragraph. It is entity, not entity specific. So it is not based on the intentions of the company that this will be fair value, that will be fair value. Right? So the alternative use would need to be based upon fair and reasonable assumptions. In particular, it would be necessary to ensure that the planning permission to demolish. Now, you have to talk about the facts in the case. What are they? The demolition factor, that you have to demolish the factor. So in particular, it would be necessary to ensure that planning permission to demolish factory and convert it into residential properties would be likely. Where is it? Necessary to ensure planning permission to demolish factory and convert it would be likely. Is it likely? Of course it is likely. That you can get a planning permission and demolish the factory and convert it into residential property. Since several nearby sites have been given such permission, this would appear to be the case. How are they saying? They are not saying just like that only. They are referring it because nearby servers have got that planning permission. Okay. In case you forgot the case study, I am sure by now you forgot the case study. Always keep that case study in front of you. Definitely you will be giving an exam in June. The next session, so the June, it will be CBE platform. So there you will have the case study. There you will not have this trouble of, turning pages and all. You will have that exact case study in front of you and you will be answering. Here, just read this paragraph only, that paragraph only, where they have talked about this. Let us read it again for you to refresh your memory. Here, from here we have to start. Fair value of net assets, excluding the following asset. The company purchased a factory before the accusation and land and property have increased significantly. Before, nearby sites have acquired and converted. See, nearby sites have acquired and converted into residential use. Exactly what they have told in the answer. It is felt that should the company site also be converted to residential use, the factory would have a market value of this much. Clearly, they have identified the market value also if it is converted to residential use. And also 1 million cost are required to demolish the factory. Here, it is the intention of the company. See, it is not. They are not intending to convert the site at acquisition date and so planning permission. So the fair value does not go by the intention, right? That's what they are saying here. Now come to the fifth paragraph. Now you have to calculate the fair value. Till here you explained what is fair value. Now you calculate. That calculation is not so long. One line only. You have to see whether you have to include that fair value with net assets or not. Fair value of net asset has already been given, excluding this factory part. Now you have to see whether you have to include or not. So the fair value of the factory site should be valued as if converted into residential use. The ones which I'm highlighting has to be there. Other things you can write in your own words, change here and there. That is up to you. But this has to be there as it is. It should be converted into valued as if converted. It is C. Currently at the date of accusation, is it converted into residential use? No. Did they get the planning permission? No. But when we calculate the fair value, we have to assume that it is a residential property. It is for a residential use. That's how we get the fair value. Because it is likely. Right? Nearby site have got the permission. So it is likely, even if not now, but in future, it is likely that they will be converted into residential use. So you can use a fair value. Because that is the highest and the best use of the property. Since this cannot be determined on a standalone basis, the combined value of the land and building is calculated. The 1 million demolition and the planning cost should be deducted from the market value of 24 million. Right? Standalone you cannot say specifically. So you are taking the combined value of land and building. Right? The 1 million which is there, it is deducted from that 24 million market value. So the fair value of the land and buildings, now they are giving you the fair value of the land and building should be 23 million. 24 minus 1. And the fair value of the identifiable net assets, now you are telling the fair value of it's very important that this part you get it correct, because next is what? Your goodwill you have to calculate. If this you go wrong, your goodwill also you will go wrong. Remember that, because NIC you have to calculate, one is based on identifiable net assets, the other one is fair value of net assets. So in the where it is written identifiable net assets, you have to calculate NIC, there you will go wrong. That's why this is linked. First part of A is linked to the second part of A. That link will always be there. If let's say in part A, there are several parts under part A. All the parts are linked. That's how it is. But not part A and B. Part A is a separate thing, part B is a separate thing. So the fair value of the identifiable net assets is now 88 million. How 88 million? Because I will take you through it. Here, it is 65 million before this asset fair value of factory. Now 24 minus 1, you add 23. You are adding 23, so it's becoming 88. So with this we finished this part of requirement. Let me change the color of the highlight. Okay. Fair value of factor size should be determined at this part of the requirement we finished. Now the second part is this one. I will write it in yellow. How this is unlikely to be reasonable estimate of the fair value. This part only we are answering in this paragraph, the last paragraph. Sometimes your answer could be in one paragraph also, sometimes it takes more paragraph. So let's read what the answer says. Depreciated replacement asset should also be considered as a possible method for estimating fair value of asset when other more suitable methods are not available. Read it again. This method is available when other methods are not available. So this may be the case when the asset is highly specialized and market. When asset is highly specialized and market data is therefore limited or unavailable, that time this is available. Right? Right? This in this condition, yes. Because for asset which is highly specialized, right, it's hard to get information about it. It's only for that. It is not openly. There are not so much of assets like that where you can get the fair value, where it's easy to get fair value. Open market is not available for those. And also market data is limited. In that condition, yes, the depreciated replacement cost you can use as a fair value. This is not the case with the factory site. Can you see? This condition it does not apply. In any case, the rise in the value of land and properties, particularly for residential use, would mean that to use depreciated replacement cost would undervalue the asset. Because they have clearly told that the prices are rising for residential use, if it is for residential use. But if I are using depreciated replacement cost, asset would be undervalued, right? So the exit value for the asset, whether it was based on principal or most advantageous market. Based on principal, what is this principal and most advantageous market? You will understand if you are thorough in Ifrs 13. Read Ifrs 13 to understand what is this. I'm not explaining it here. So the exit value for the asset, whether it was based on principal or most advantageous market, would need to be the same as the entry price. Same as entry price. Depreciation may not also be an accurate reflection of all forms of obsolescence, including physical deterioration. Yes. Just because it is depreciating, you cannot say it is physically deteriorating or something like that. It's not the accurate reflection, right? So the estimate would need to be adjusted for such factors even when industrial use remain the best use of the asset. Right? The estimate has to be adjusted a lot. That's why it's not a reliable fair value. So with that, we finished requirement A, first part. I'm putting a tick mark. Now second, calculation of goodwill. This should be easy. So how you're calculating fair value. When you're calculating fair value, just see the method they are doing. Simultaneously, they are doing two. Line by line. Both together they are doing. This saves time. Because only once you are writing consideration, there also you have to write consideration. NIC, there also you have to write NIC. All these are repeated. So just write once only. And put two columns and separate it like this. Fair value, proportional method. Okay, and don't deal in millions. You can omit the millions. And just write the number. So the consideration will be same, 90 million, 90 million. Right? Consideration. If you forgot how we took the consideration, this is this 90 million. Next, NIC. Net asset, NIC at fair value is 22 million. So if you're taking the fair value, it is 22 million here. But here, it is 17.6. How 17.6 we are getting? How 17.6 we are getting? For that, go here. I told you mark 20%. So NIC is 20%, right? %20 of what? %20 of what? Net asset. Net asset. Identifiable net asset is how much? 88 here. From here, you cannot take 65 anymore. You have to take this 88. Just now you calculated it. So here, it will be, here they have done the calculation also for you. How they got 17.6. 20% of 88. Next, net assets or accusation will be same. 88 and 88 under both. Next, goodwill. You see, the goodwill is different. So this is how you have to show your workings. Not in the main table, but here down below the table you are writing the main working. This is working 1. Here, this you can write or you can say, right? And net asset. Just now you are calculating B. And this is for the tutorial note. This will not be in your answer. Right? Goodwill under proportional method could be calculated as consideration minus less fair value of net assets acquired and the goodwill. So this is another method to calculate goodwill. You should get the same goodwill. Okay, this is for tutorial note only. Now coming to part B. So part B, it is only this paragraph we need, the impairment part. We have to tell how the difference of NIC measured will have an impact on the impairment. And explain also. So we are going to read this paragraph now. The company incurred losses during the year 30th June 2008 and an impairment review was performed. The recoverable amount estimated was 100 million. What is the recoverable amount? 100 million. Included in this assessment was the old building owed which has been damaged in a storm and impaired to the extent of. So what is it? The old building. This is this impaired to the extent of this much. 4 million. The carrying amount of the net asset at 30th June, excluding the fair value adjustments on acquisition but excluding goodwill, are as follows. It included fair value adjustments but it excluded the goodwill. So the carrying amount of net asset is this much. 106. Now, none of the assets including goodwill has been impaired previously. That they does not have a policy of revaluing its assets. So including goodwill has not been impaired previously. None. Now what do you have to do? You should impair the goodwill or not? Definitely you should impair the goodwill. If you see part B. Right? Just wait a minute. I think it has been repeated. Wait a minute. Okay. So here, let us read the answer. An impairment arises. What is impairment? So whenever you have to answer a question on impairment, start with the definition of impairment. Very briefly, one line is enough. So an impairment arises when carrying amount of net asset exceeds the recoverable amount. We all know that. Where there is a clear indication of impairment, this asset should be reduced to the recoverable amount. When there is an indication. Where the cash flows cannot be independently determined for individual assets, they should be assessed as a cash generating unit. Make sure you know what is this cash generating unit. I'm not going to explain here in this video. Right? You should know what is this IFRS. Which IFRS this one is? IAS. This is the smallest group of assets which independently generate cash flows. Impairment of cash generating unit is allocated first to goodwill. This you have to know. This is a rule. First it is allocated to goodwill and then prorated on other assets. It should be noted that no asset should be reduced below its recoverable amount. No asset can be reduced below its recoverable amount. That you should know. Fair value method. So now you are going to talk about two methods. First is fair value method because you have used previously fair value method. And next is the proportionate method under both method. Don't mix up the two methods. Keep it separate. And mind you, here you will have calculation also, discussion also. Both. So the overall impairment is 30 million. How are you saying that overall impairment is 30 million? How much goodwill you calculated here? 24. Keep this goodwill here with you. Okay, and here you have how much? 106 is the total. So 106 plus the goodwill minus what? Minus the 100, no? Recoverable amount. . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . So that's why total plus goodwill minus 100 the recoverable amount. This is your overall impairment because it is greater than your recoverable amount. So the carrying amount of net asset greater than recoverable amount means there's an impairment. Impairment is 30 million. So the damaged, so this type of calculation no need to do as a separate working and all. In one line you can show the working like this, how they have shown. The damaged building should be impaired by 4 million because they told that damaged building, the impairment is 4 million. So this should be impaired by 4 million with the corresponding charge to P&L. Since 4 million has already been allocated to the land and buildings, they have already been allocated to land and buildings, 26 million remains. Out of 30, 4 million gone, so 26 million remains. How can we see that? That it has already done this or not? How can we tell that? Because here they told, included in this assessment was all the building owed by the which has been damaged in a storm and impaired to the extent of 4 million. So that 4 million will go for the land and buildings. Right? Because it has been allocated to land and buildings. All the building they told. So out of the 26, and the goodwill should therefore be written off an expense in consolidated P&L. Yes. Goodwill will be written off as an expense and in consolidated statement profit or loss. Where will expense go? P&L. Consolidated P&L. Because this is an accusation. So consolidation will come. Now, of the remaining 2 million, 1.25 million will be allocated to the plant and machinery and 0.75 million will be allocated to the remaining intangible. How are they calculating this? Why are they saying of the remaining 2 million? The calculation is here. How much it will be allocated to plant and machinery. Then the remaining intangible. Of the remaining 2 million. How much will go for plant and machinery and how much will go for intangible? How 2 million? How are they saying that? Because from 106, 100 is the what? Recoverable amount, right? So it is 6. Out of the 6, how much it goes? Land and building, 4. So the remaining is 2. Where will this 2 go? So you have to take this and this for other plant and machinery and intangibles other than goodwill. So when you calculate it, 15 over 15 plus 9, the intangible and the plant and machinery of this 2 million. So 1.25. And the remaining will go to intangible. This is the calculation and this much. As no asset has been previously revalued, all impairments are charged to P&L. When there's no revaluation of assets, what happens is all the impairment goes to P&L. All the impairment. This also you have to write where it will be charged to P&L. Right? So what is the value of this thing? NIC is 20%, that means 80%. They have acquired 80% of what? 30 million. How 30 million? Because impairment is 30 million. Where is it? Here. Impairment is 30 million. So this 30 million is for whole. You only want to exclude the NIC only for the parent company. 80%. So 80%, that is 24 million. 80% of 30 will be attributed to the owners and 6 million will be to the NIC in the consolidated statement of comprehensive income. Because they have told what is the impact of impairment on the consolidated statement. So you have to clearly tell this is the impact. 24 for parent, 6 for NIC. Now, allocation of the impairment is summarized in the table below. This is how it will go. Right? This exactly you can copy paste, but here one thing you have to write goodwill. Goodwill is added here, 24. That's it. Rest all remains the same. Next. What is the impairment? Impairment 4 you are taking from here, 1.25 here, 0.75 here. Wholly you can take for goodwill. Then 30 is your impairment. Right? Here revised. So after you deduct your original from impairment and this will be the revised value. You will be left, this is your recoverable amount. Right? It should be equal to recoverable amount only. Show this also. Now coming to the second method, proportion method. Now, since you have understood the base of the fair value, we can go a little fast in the proportionate value. It's just the numbers are different. That's it. So the basic principles and rule for impairment is the same as fair value, and 4 million will be again. This 4 million again will be first written off against land and building only. There's no difference. Problems arising when performing impairment review as a cash generating unit when NIC is measured using proportional share of net assets. No goodwill is attributable to NIC since goodwill is not included within the individual net assets of the subsidiary. Yes, this means that the goodwill needs to be grossed up. Here you have to gross up the goodwill when impairment review is performed so that it is comparable with the recoverable amount. You have to compare this with recoverable amount. Under the fair value, NIC fully represents any premium the other shareholders would represent to pay for the net assets, and so goodwill does not need to be grossed up. When it's a fair value, don't gross up the goodwill. Take as it is 24. Here you have to gross up, proportionate method. When you have to compare with the recoverable amount to see the impairment or not. So the goodwill of 19.6, this we have calculated in the second part of A, that under proportionate, this was the goodwill. 19.6. If you forgot, we can go up and show you this one, 19.6. But this needs to be grossed up. So if you gross it up, 20% was NIC. How much it will be? When you gross it up, multiply by 100, divide by 80. This will be the gross up amount. This extra 4.9. That means 24.5 minus 19.6 is 4.9 is known as notional goodwill. The overall impairment is now with 106 is the total. Add your goodwill, deduct your recoverable amount. This is now your impairment. Out of this, 4 million will be allocated to land and buildings. So, if 4 million from 30, then the remaining 26.5 million exists the value of goodwill. Right? This impairment exists the value of goodwill. What was the goodwill? 24.5. So, it cannot happen that your goodwill is more than, impairment is more than goodwill and it becomes a negative number. It has to be 0. Cannot be a negative number. So, the goodwill is written down to 0. Goodwill in that case is written down to 0. You cannot fall below 0. That's a rule. Cannot be negative. It cannot be 4.5 minus 26 or minus 2. No. 0. So, however, as only 19.6 million goodwill is recognized within consolidated accounts, the impairment attributable to the notion goodwill is not recognized. Only 19.6 million is deducted. So, only this is deducted. This is the parent company. Is deducted from the owners. Because this 19.6 is for the owners. So, it will be deducted from the owners of the share of profits. Since there is no goodwill attributable to NIC. The remaining 2 million is how remaining 2 million? Because 26.5 minus 24.5. So the remaining 2 million, how it will be allocated? Is allocated between plant and machinery and intangible, same like fair value, other than goodwill. Okay. So NIC will be allocated how? 20% of 6 million. 20% of 6 million. Why 6? 2 of the unallocated impairment and 4 the allocated one for land and building, which is 1.2. So the consolidated retained earnings will be charged as 80%. Consolidated retained earnings 80%, not the NIC's part, the parent company of 6 million, which is 4.8, plus 19.6 million goodwill impairment, 24.4 in total, because 19.6 plus 4.8, the consolidated retained earnings and the impairment. The allocation of impairment is summarized. So this is how the allocation is summarized in the table. Make sure notional goodwill, impairment of notional goodwill does not impact on the consolidated financial statements. Please write it. If it does not impact, write that it does not impact. Don't leave it like that. That just because it's not impacting, I will not write anything. So here also everything remains the same except notional goodwill after you gross up and the goodwill which you have calculated. Rest all is same. Here it will be same. The impairment will be same. Here is the full amount and the full amount. This has to be 30.5. This has to be the recoverable amount, only 100. Okay. Coming to part C. It's a little bit complicated. Not complicated. It's like impairment is a little bit boring, I would say. It's like very dry. It's not much of interesting things are not there, but make sure that you study it because impairment is very important. It's like a key subject, key area you need to focus. Some areas does not, okay, you can leave it also. Luck, it does not come all that, but such areas like fair value, impairment, intangible assets, these areas will always come. You cannot leave it. Some or the other area, impairment will come. Impairment comes in all the past paper. So this part you cannot leave it. Like share-based payment, this type of question does not come very frequently, right? But impairment definitely it will come. So coming to part C, the last section, we just have 2 more sections. For that we have to read this, the last paragraph. Now you see how easy it is. Just because I'm focused on one paragraph, I can able to maximize my performance and take as much information as possible. I can retain also. When I'm reading the whole, I'm going from here to there, wondering where to take information. Here, there, I'm searching. So accusation. So the company acquired 60%. How much it acquired? 60% of the 10 million equity shares on 1st of July 2007. Very important is the date, because for your vesting period and all, date counts a lot. The 2 shares are to be issued for every 5 shares acquired in Hammond Company. 2 for every 5 shares in Hammond. These shares will be issued on when? 1st of July 2008. The fair value, what is the fair value at that date? Is this at 1st July 2007. The Hammond has previously granted a share-based payment to its employees with a 3-year vesting period. 3-year vesting period. At 1st of July, the employees had completed their service period but has not exercised their options. The fair value of the option granted. So what is the fair value of the option granted? 15 million. As part of that accusation, they are obliged to replace the share-based payment scheme with a scheme of its own, which is the following details. Now let's read the following details. Share-based payment is also an area which is not very big, very small area, but it can be quite complicated if you are not understanding, especially the sequence of the event matters a lot. On what date on what day they are granting, on which day they are exercising, which day the employees are leaving, which day the new employees are coming. Very important to keep a track of it. So Leopold issued 100 options to each of the Hammond Company's 10,000 employees. How much it issued? 100 options, each of 10,000 employees. The shares are conditional on the employees completing a further 2 years of service. It is conditional. employees for the 2 years of service. Additionally, the scheme required that the market price of shares had to increase by 10% from its value of 30 per share at the acquisition date over the vesting period. So, market price, it has to increase 10% from 30 per share at acquisition date over the vesting period. 3 years is the vesting period, right? It was estimated that 1st of July 2007, the 10% of staff would leave over the vesting period. So 10% of staff leave over the vesting period, but this was revised to 4% by 30th June 2000 after 1 year. So the fair value of each option at the grant date was $20. The share price of Leopard at this date was this and is anticipated to grow at a similar rate in the year ended 30th June 2009. When is it? Starting on 1st of July 2007. So July 2007, 8, 9, right? Now, what is the first requirement says? Consideration. How the consideration of the acquisition should be measured on 1st of July 2007. Okay. So let us go to part C, first part. 4 marks only. First paragraph, second paragraph, third paragraph. First paragraph, they are talking about IFRS 3. Business combination. You have to talk about this. IFRS is important here. What does this IFRS talks about? It requires all consideration to be measured at fair value. All considerations to be measured at fair value on an acquisition of a subsidiary. This will include the deferred shares also. Since Leopard is obliged to replace the share-based payment of Hammond at acquisition, the replacement share should also be included as consideration. Yes, because they told they want to replace it. That's why this replacement scheme has to be included in the consideration. Otherwise, it's not always that it has to be included, but here it is. There is, however, post-combination service period, which means that proportion of the replacement scheme attributed with the pre-combination service is the market value of the acquiring award, multiplied by the ratio of the proportion of the vesting period completed to the greater of the total vesting period of the original vesting period of the acquiring award. Now, this sentence looks complicated. Okay, for this to understand, you have to know your share scheme payment scheme, IFRS 2 properly. So read it and understand this part. If you're not understanding it, you can comment me below down and I will come to you. Personally, I will be explaining you it. Okay. Next paragraph. The vesting period of the acquired award has vested and was 3 years. Talking about the vesting period, you have to talk about the vesting period. As there is a 2-year post combination vesting period. 2-year post after the acquisition. Right? 2-year post combination vesting period. The total vesting period is 5 years now. 3 and 2. Therefore, the amount attributable to the pre-combination period and therefore added to the cost of investment. Yes, pre-combination period will be added to the cost of the investment. How much it is? How much it is? What is it? Let's read it. The fair value of the option granted. You have to see the fair value of the option granted was 15 million. This will be over the vesting period, 3/5. Out of the total 5 year, only 3 years pre-combination period you are taking. That's why into 3/5 and you are getting 9 million. Until you don't understand this, you will not understand the below, the later ones. So deferred shares should be measured at a fair value of the acquisition date, right? Even though it's deferred, it has to be measured at what? Fair value of the acquisition date with subsequent changes in the fair value ignored. Whatever subsequent changes happens in the fair value, it is ignored. So how much they will issue? How much shares they will issue? Because we know that even share also you can give as a consideration when you're acquiring a company. It's not always cash. Sometimes you can give cash, shares also. So how much of that share you have to issue? You have to calculate that. How much it is calculated after acquisition, that is 2/5, now 3/5 now post acquisition. 60%, 10, because you are acquiring 60% into 10 million. How 10 million? 60%. Why? you acquired 60% and of 10 million equity shares of Hamlet. This is the reason why. This definitely will come as an accusation, consideration. So which is 2.4 million they will issue. Now, they will issue this much, but what is the market price? The market price at the date of accusation was $30. This is the market price of the accusation. So the fair value is 72 million. Because 2.4 into 30. So the total consideration should be valued as 81 million. This is the total consideration. 72 plus 9. 9 pre and this 72 million after accusation, post accusation. Add it and it will be 81 million. Again, we'll see. Market value was $30. So here, the value is 30 per share at the accusation date over the vesting period. The market price. Even here they told the fair value at low per share was 30. So make sure that you keep how to understand this better. If you're asking me this question on Ifrs 2, you have to practice each and every question on Ifrs 2, because each and every question you will see there's a similar pattern. Only the numbers are different, vesting period is different, right? But the rest all remains, the principle remains the same. So keep on calculating, doing questions one by one after the other. You will know it. That's how you will understand it better. There's no other way. Trust me. Until you yourself calculate and find out, you will not understand it. So don't see those videos how they are doing. You will not understand until you calculate. Yes, you can see the video for understanding purpose, but just seeing the video, not doing anything, not practicing will not help you. The last part. Okay. So if you're coming here, how much of an expense? This one. They will be recognized as in the consolidated P&L, and brief discussion of vesting period will have an impact upon the calculations. It's just for 4 marks. So even the answers are short. So the fair value of the replacement share the grant rate is this much, 18 million. The fair value of the replacement scheme that you have to calculate. How? Same, this is fixed method only. 100 into 10,000 into 90% into 20, which is 18. Understood anything? I'm sure you didn't understand what is this 100, 10, 19, 20. Leopard issued 100 options to each of the 10,000 employees. So 100 into 10,000. Okay. And they have told that Leopard share have to increase by 10%. By 10% means after the increasement 90%, right? Multiply by 90%. Why 20? Because the fair value of each option at the grant date was 20. Always multiply the fair value of the option at the grant date. This method, this you will better understand when you go to Ifrs 2. So 100 into 10 into 19 into 20, which is 18 million. Since the 9 million has been allocated to cost of investment, right? This 9 million cost of investment, because that is the consideration we told. Consideration means cost of investment only. The remaining 9 million out of 18 million, 9 million has been allocated to the cost of investment. Okay, so the remaining 9 million should be treated as part of the post combination remuneration package for the employees and measured in accordance with Ifrs 2. So that remaining 9 is remuneration package, post combination, after accusation, the remuneration package. The fair value of the grant date of the share based scheme should be expensed to P&L. Fair value at the grant date of the share based scheme should be expensed. It's an expense you are giving, right? Fair value of the grant, you are giving options. So when you're granting that option, it's an expense only from the company which is going. So it has to be given as an expense, written as an expense in the P&L over the two-year vesting period. Post accusation, right? 2-year vesting period. Subsequent changes to fair value. See, subsequent changes to fair value of the shares are ignored. Remember this. It's a rule. Read IFRS 2 for more, understand better. Now, until this much, okay. First part of the requirement is over. Second part, they told about vesting period. How changes in vesting period will have an impact on the calculation. This is this part, the last paragraph. If you see, it is just 4 lines. 4 lines only. Look at your marks and then answer. Don't write 10-20 lines or 5, 7, 8, 9 lines. So LUPET will need to consider the impact of market and non-market vesting conditions. Yes. Vesting conditions means they are talking about this market and non-market based vesting conditions. You should know what are this market and non-market. These are your theory parts. It's there in IFRS 2. The condition relating to the share price is a market-based vesting condition. Is it it's a market-based. Market will change, share price will change. These are adjusted for in the calculation of the fair value of the grant date of the. So this has to be adjusted in the calculation of the fair value of the grant date of the option. An expense is therefore reduced in the consolidated P&L. Yes, expense will be recorded where? Consolidated P&L of the parent company, irrespective of whether the market-based vesting condition is met or not. See, share price changes. These are market-based conditions. Market-based condition change or not does not have an impact. Expense will be recorded in the consolidated P&L. Whether you have met that condition or not, whether the share price has increased by 10% or not, because share price increased by 10% is a market-based condition, market-vested conditions. Even if you met or not, does not matter. But other conditions, performance conditions, those you have to meet. Like you have to be in a company for 2 years, that you have to meet that condition. A corresponding credit should be included within equity. Expense is debited, right, in P&L. So where will be that credit entry will go? Within the equity. Within the equity. So that's it for question 1. Next is question 2. I'll be coming up with question 2, 3 and 4 for the same paper, September, December 2019. Till then, take care. God bless you. Bye-bye.